Good morning and good afternoon, everyone. Lovely bit of energy in the chat going on at the moment. Apparently, and I'm not sure if this is a lie or not, but there's no tolls in Adelaide. So I'm not sure if that's a joke or not, but if it is, I dare say I'm living in the wrong state. Tony, that's wild. That's absolutely wild. Is anyone here from WA? They've joined us at 10 a.m. If you are from WA and you are tuning in, we really appreciate you guys having to endure the different time zones. Awesome. Now, before we proceed, is anyone here is anyone here new? Is anyone here understand everything about today's webinar, but they're just trying to get a refresher, or some of you guys completely oblivious and you're just hoping to, I guess, educate yourself? Feel free to chuck it in the chat. Awesome. Good mix of learning and refreshers. That's excellent. Hopefully, guys, everyone will be able to get something out of this today. So we really appreciate everyone participating. So for those of you who are new, we do have a lot of veterans here. I can see the names I recognize. But for those of you who are new, my name is Joel Comerford and I'm your webinar host. Welcome to Lawpath's webinar today, How to Read a Profit and Loss Statement and Balance Sheet. Now, before we go on, I will just let anyone who is new know you will get a copy of today's webinar in an email I send later on. You'll get the slides as well as a YouTube link, as well as discount offers for today and everything else. Now, please go ahead and save your questions for the Q&A. You will have a little Q&A icon down the bottom so you can chuck your question in at the start, throughout, or at the end. Just to keep the ball rolling and to keep a bit of traction, we will go ahead and save questions to the end. So yeah, if you guys can just hold out, we will have the Q&A at the end. And yeah, that should be everything for upkeep. So first off, thank you all for taking an hour out of your day. I understand most of you guys are entrepreneurs and business owners, so 1 hour can be quite taxing. So we really appreciate you sitting down and choosing to spend your time with Lawpath. For those who may be new, Lawpath is Australia's leading online legal and accounting platform. Over the past 10 years, we've helped more than 600,000 clients simplify legal, accounting, and compliant tasks through affordable subscription-based plans. Instead of unpredictable hourly rates, our model gives businesses unlimited access to the advice and documents they need whenever they need it, saving small businesses hundreds of millions of dollars in the process. Now, why does today's topic matter? Whether you're a founder, a manager, or just someone wanting better visibility over your numbers, understanding your financial statements is non-negotiable. Your profit and loss statements tell the story of how your business is performing over time, while your balance sheet provides a snapshot of its financial health. So together, they're the foundation for smarter decision making, stronger cash flow, and being ATO and investor ready. At Lawpath, we want to empower you guys to read beyond the numbers and use them as tools to grow and protect your business. Today's speaker, always delighted to introduce, is Timothy Quinn, our head of tax and accounting here at Lawpath Tax and Advisory. Tim is a chartered accountant with over 18 years of experience advising businesses on tax planning, structuring, compliance, and financial strategy. He's led tax divisions at the director level and worked with businesses of all sizes to optimize their tax positions and financial reporting. Moment. Forgive me, I didn't realize I still had my phone on. Now, so at Lawpath, Tim, he heads up our accounting and tax team, helping our clients not only stay compliant, but also unlock growth opportunities. So if anyone here is on our accounting or tax plans, almost anyone that you speak to in regards to our accountants and tax agents have been personally selected from Tim. And if you are new, I'm sure you will see just how proficient and knowledgeable Tim is. So, you know, very rigorous guy. He's not going to just hire anyone. So hopefully that's a good indication of the kind of services and knowledge you'll be getting from our team members. Now, what is Tim going to cover today? Understanding a profit and loss statement, what it shows, how to break it down, and what numbers matter most. Breaking down the balance sheet assets, liabilities, equity, and how they reflect the true health of your business. Key financial ratios, the vital signs that reveal liquidity, profitability, and efficiency. Try saying that 3 times, God. As fast as you can. Applying financial insights to planning, so using reports for budgeting, forecasting, and investment readiness. Common red flags, the warning signs to look out for, declining margins, cash flow stress, and high debt ratios. And also how Lawpath can support you guys beyond today. So everything Tim will cover ties directly back to Lawpath subscription plans. Our accounting advice plan gives you unlimited 30-minute consultations with accountants, ensuring you can get tailored insights on P&L, balance sheets, cash flow, and tax planning whenever you need them. Our tax plan ensures your BAS lodgements, financial statements, and annual tax returns are handled by a dedicated tax agent, so you never miss a deadline. And then we also have our legal advice plan for those of you who are also might be new and you are considering legal as well. Same premise as the accounting advice plan. It gives you unlimited access to our senior lawyers for contracts, structuring, and compliance questions because finances and legal go hand in hand. And for those who want all-in-one coverage, we have business success bundles, which basically encapsulates everything I've mentioned. So you can get all of your legal, accounting, and tax under one roof at a click of a button whenever you need it. Excellent. So that is the upkeep, guys. We will go ahead and pass it over to Tim, and then we'll proceed further into how our plans might be able to assist you later on as well. So please, guys, we love the communication. Go ahead and throw some questions in the Q&A. We will get around to them. And if you've just dropped in, if you are new and you have to leave the meeting early or later, whenever it may be, we will send an email out with the slides and the recording as well. Thank you so much and welcome.
Thank you very much, Joel, for the very kind introduction as ever. Before we jump right into the guts of these P&Ls and these balance sheets and all this accounting terminology, forgive me, but I'm going to start with a confession. That confession is I love being an accountant. I really, really enjoy it. And I know a lot of you are probably recoiling in your seats and thinking, how can someone possibly love it? It's so dry. I don't think it is. I think accounting is a language. It's a language that tells a story, and it's a shared language. It's something that once you've unlocked it, once you've unlocked its myriad of secrets, it teaches you how to describe businesses stripped back. No fluff, no marketing, no wishful thinking, no pie in the sky ideas. Accounting is a way of at a glance, at a 2-page glance, seeing how a business has gone, telling the story of what the last 12 months or 6 months or quarter has been like, and a snapshot. What have we got? What are the risks? What do we owe? And it's a really powerful and powerful thing to unlock. Now, I'll be honest. I know it's probably more of a me thing. I know there's plenty of people out there that don't love accounting as much as I do. That's okay. You don't need to build up the degree of fluency that I've got over 2 decades in this sort of area. I'm going to teach you a shortcut. So think of this as your shortcut. 2 weeks before you've stepped off on holiday, you're going over to Europe or maybe over to Japan. You're not going to learn the ins and outs of this language in that time. But gee, won't it be helpful to sit in a bar in Madrid and order dos cervezas and just be able to talk enough of the language to get by. The reason why I think that's so powerful, particularly with accounting, is that I have been doing this for a long time. I've met with lots of people that have started businesses, lots of success stories, but no bones about it. Lots of failures as well. That's the reality of running a small business, is that lots of them do fail. I would say the closest aligned statistic to the clients that have succeeded versus those that have failed, those that have taken the time to learn a little bit about their business from an accounting perspective. Doesn't mean you need to know all the nuts and bolts, but if you can understand the profit and loss report and the balance sheet report, you are putting yourself at the top of the pack. You're giving yourself every opportunity for success. And it's not as complicated as it sounds. For those of you out there that are using accounting software like Xero or MYOB or something online, A lot of the nuts and bolts are taken care of. The P&L and the balance sheet are just reports. All they're doing is taking the information these systems already have and presenting it in a way that tells the story of your business. Let's get into it. What are these? What are these P&Ls? What do they look like? I'll show you. The P&L basically tells you the story. A P&L, or a profit and loss statement, is always a report over a time frame. So you have to tell your accounting software or ask your accountant, I want to see a profit and loss for the last year. So an annual profit and loss statement is a very common one, typically by July to June, but you can run any period you want. If you were treating this like a narrative story, you'd start at the beginning of time. Maybe if you're telling someone like a bank or an investor the story of your business, they don't want to know from the beginning of time. They might say, cut to the chase. How's the last 12 months been? The accounting equivalent of that is selecting that time frame and saying, well, here's my profit and loss statement for this period. Tells you the good, the bad, and the ugly. Ultimately, it gives you the bottom line. It tells you, are you profitable? It's a very important thing to understand in your business. I would say the number of small businesses that actually understand their profit level is much smaller than you'd think. When you're in the weeds of it, when you're running your business day to day, it's hard to step back and say, well, have I actually made a profit? There's money coming and going, often going out more than it feels like it's coming in, but it's hard to really sit back and assess. This profit and loss in the accounting knowledge will show you, it'll show you your income, your expenses, and what's left at the end is your profit for that period. This is probably the first, well, it is the first report in any sort of accounting pack. It's certainly the one that investors and lenders will look at first to assess how your business is performing. Shows you growth, because again, this is over a period, but you'll have often a comparative period. So you might say, well, here's how we went this year. Here's how we went last year. Here's how we went 2 years ago. Can tell you a lot about a business in a very, very short, often one-page document for a small business. So we start with your revenue up the top, and I will show you an example in a second. Pretty straightforward. It's your sales, it's your income. The second most line is COGS, which is basically what are the direct costs in delivering that service or selling that product. If you were selling glassware, your COGS might be the cost of buying glass or the silicon, even if you're depending on what stage of production you're in. That if you take your revenue, subtract your cost to deliver that revenue, that is your gross profit. That's a very important measure of your business. If your business can't make a gross profit, it might be time to think about doing something else because that is the core product, the core business of what you're doing is buying something, transforming it and selling it, whatever that something is, you need to make a gross profit. After that, there's all the very boring expenses just of running any old business. So rent, if you've got a warehouse or an office, of course, your wages, marketing, and all of those administration costs. So if you take your gross profit, subtract your operating expenses, what you're left with is your net profit. So that's a very, very important number. What does that look like? This is a nice simple demo company from Xero. So those of you that do use Xero, which is a fair bit of you, this report might look familiar. Interestingly, for small businesses running Xero, you might not have actually run this report, which seems really crazy for us accountants because it's the first thing we go into. If you're in a business and you're running from that dashboard view, and you're reconciling transactions, you're saying that's what this is, or you're issuing invoices or doing your payroll, you might not step back and run these reports. For us, we basically live in these reports and we know how powerful they are. So just that's a very simple looking profit and loss. Take your time to look through it. If you've got any questions about them, scribble them down to yourself or chuck them in the Q&A and we'll come to it. But just to walk you through exactly like we talked in theory in the last slide, it's got your income up the front. So if we focus on 2026, which is the current year, we can see our sales. We can say that our cost of sales is very negligible in this made up imaginary business. So our gross profit is huge. Fantastic. Good for us. What a business. Alas, those operating expenses add up, don't they? So you can see that, of course, while we might have made $48,000 of income there, if you look right down the bottom, you can see a wages and salaries expenses line. So we might feel like this business was doing really well because we've had sales coming in. But we also know that at the back of that, once a month or once a fortnight, we've been paying those wages and salaries. This is telling you the story of a couple of things. It's a newish business. Looks like it was only started in 2025. You can see very little income in 2025. Things were just getting off the ground. What else does it tell you? It tells you we've had some sales this year. That's not too bad. It's a good start. Plenty of businesses never even get to that level. We can tell that we've got wages and salary, so we know we've got employees, and we know that that comes with pressing costs because you can't defer them. Wages and salaries have got to be paid on time, otherwise you lose tax deductions, you get in big trouble with the ATO, and you get in trouble with Fair Work and everyone else. So we know that we're going to get some pressures in this business because most of our expenses can't be pushed back. Now, we don't know yet because we're only looking at the profit and loss, but might not be collecting that $48,000 of income until way down the track. For those of you that deal with large customers, any of you who have the pleasure of dealing with those big conglomerates that have a lot of market power that you're selling to, if you're a business to business business, is that they will often have very long payment terms. So in some businesses, you might not get paid, actually get the cash transferred for your sales for 90 days after you've made that sale. Well, too bad for you if you're running this business because your payroll needs to be paid straight away. But perhaps your sales don't get collected straight away. So you can already see there are questions coming up, even from a very simple profit and loss. The first thing I do when I get a new client is I always look at the profit and loss and the balance sheet. And I start thinking, what questions is this unlocking for me? What do I need to understand to help this client succeed? These are the questions that I start thinking about. As you can see, at the moment, the total expenses are greater than our income. Hence, for this company, it is at a loss. So those brackets you'll often see in accounting are a nice, easier way to see negative numbers. You might just ask, well, why not just put the minus sign next to it? Trust me, when you're looking at this all the time, the brackets are a lot easier to read. So for this business, we've got $48,000 of income. We've got $57,000 of expenses. So we're in a loss position of approximately $9,000. That is a very simple profit and loss. If you do have questions, I look forward to answering them later. So what are some things that we can look for in a P&L? We can see growth. We can see changes. We were comparing two different years there. A year on its own doesn't tell you an awful lot. Potentially, this is a good news story. Potentially, if we were to compare it with the year coming, it's showing growth. It's showing, yeah, we might have lost money, but we might have plenty of money to sustain that loss. It might be turning around. So we can compare periods. We can get call outs for things that don't look right. That's often the first thing we do. I used to be an auditor, so anytime I'd get as an auditor, if I tried to look at what was wrong, just having a look at the profit and loss, does it make sense? Does that make sense with what I know about this business? And potentially for you, the first time you run a profit and loss report, you go, hang on, that doesn't make any sense. I know my business better than anyone. That number's not right. Potentially it's not. Potentially things have been miscategorized. Now, you might think, well, who cares? The profit figure is the profit figure. Potentially not. You might have classified something on the profit and loss that should be in the balance sheet, which means maybe your profit figure is wrong. So it's really useful to understand a story, to understand where things are going. Is there improvement, or are things getting worse? Are there costs that are getting out of hand? But also, are there potentially errors in there? Are there one-off costs, particularly if you're new to business? Your P&L in the first year looks terrible. Every first year business's P&L is terrible because you've got those big upfront costs that you hopefully don't incur year on year. Hopefully they smooth out. So that's just some things to look out for in a P&L. This is an example. Look, you might see that your revenue's up, but your profit's down. Happens all the time. You might be in a growth phase. You might be needing to invest in marketing, potentially marketing that's non-repeating, where you're buying your market share. So your revenue's up as a result, your profit's down because that marketing was so expensive. And for any of you that use Google AdWords or Facebook marketing for your business, you'll know how quickly those costs add up. So the use case for that is that, well, you can have a look. You might need to actually change your budget. In that scenario, you might say, I've achieved the revenue growth that I'm after. Now it's time to cut back. Time to tighten the belt and cut some of those expenses down a little bit. Here's a good one I've alluded to already. Your revenue might be up, but your cash is down. So the cash we'll see on the balance sheet coming up. And that could be late payment. So it's the scourge of small business is late payment. It is very difficult to avoid. It is frustrating, and it's probably something that make you tear your hair out. But it is something that you have to be across. You can't leave accounts receivable to collect itself. Often people get in the mindset of needing to be reminded 3 or 4 times, sometimes with some red ink across it, that they do have to pay their bills. So it's very, very important to use it for that reason. If it seems like we're rushing through it, we'll keep coming back to these reports, but this is just to give an overview. We're already onto the balance sheet. So the balance sheet, why is that different to the profit and loss? What don't we know from looking at a profit and loss on its own? Profit and loss has told the story of how things have gone, how much we've had come in, how much we've had go out, and how profitable our business is. What it doesn't tell you is, okay, press pause on this story of this business. Where are we at? Let's recap. What have we got? What do we owe? That's the job of the balance sheet. So you can see why the balance sheet taken in conjunction with the profit and loss is so powerful, because it says not only this is what the last 12 months looked like, this is how we went. Okay, well let's add all that up with all the years before. Where are we up to? Can we keep this thing going? It's quite a powerful, difficult conversation to have when you look at your balance sheet. Let's go into that. The balance sheet will show you what you've got, so your assets. If anyone's thinking about what their assets are of their business, they're pretty obvious, aren't they? It's your cash. It's those accounts receivable that are future cash. Depending on what your business is, it can be machinery, it can be land, could be property, could be a motor vehicle, common asset for small businesses. Anything you can think of, really. So what's a little bit more difficult? What are your liabilities? Well, maybe you're lucky enough to be paying your invoices on credit. So maybe you know that you'll have some invoices to pay. We call them trade payables or creditors. They're all different types of liabilities. Potentially, if you've got liabilities to your employees, you're building up that annual leave balance. That's a common liability, or long service leave if they're depending on your state. I think they've all got some form of long service leave. So if you say, well, what's the snapshot of my business? You take your assets, fingers, thumbs up, subtract your liabilities. We don't like them as much. Whatever's left over, it's what's yours, basically. In a simple balance sheet, it's your owner's interest or your equity. So that's a good way of thinking about your business. A positive net asset position is what we call it. If your assets are more than your liabilities, that shows basically that, I guess, in one sense, the value of your business, the accumulated value of your business. So like we said, the balance sheet is a one-day report. You run the balance sheet as at a date. You don't run it over a period because it is just a snapshot. It's just telling you where you're up to. Very, very important. It's the second report that everyone looks to when they're looking at your business, deciding whether to lend you money or invest in your business. They say, is this business, can it cover its liabilities? That's the most important thing. Is this business solvent? Does it have the ability to pay its debts? If you're sitting on a bank balance of $100 and you know that you've got liabilities coming up of $10,000, well, you could be in a spot of bother, but better to be aware of than not to. So these reports, and this one in particular, are very, very important for lenders and investors, but also the ATO if you need to rely on them for a bit of support. So like I just said, we break it down at a balance sheet very simply, and I'll show you a demonstration in a second of assets. liabilities, and then whatever's left over. Those assets and liabilities we break down into current and non-current. Now, this is really useful, I guess, to understand what's more pressing and what's more available to you. That current versus non-current breakdown is a 12 months cutoff. So anything that's due to you or coming back to you in the next 12 months is a current asset. Anything you need to pay quickly inside the next 12 months is a current liability. And after that period, you've got longer term assets like property, plant, and equipment are a common one. If you've got a tractor, for instance, that's you're not going to you're not going to get the value of that asset just in the next 12 months. You're going to have it over a period. And intangible assets, which is really important for small businesses too. Things like the value of your software if you've been building something like that or building intellectual property. Likewise, longer term liabilities, particularly if you owe things like long service leave for employees that haven't yet hit their period of service, you typically classify most of that as a non-current liability. And then the equity section, not terribly important for small businesses. Equity in small businesses is usually pretty straightforward. Typically, you'll see what's left over. Think of that as your pool from which you can declare yourself a dividend. So almost the benefits of running your business, you make profits, hopefully. Those profits build your equity position. And when you pay yourself as a dividend, because you're the shareholder, that comes out of your equity. So you can't declare a dividend unless you've got enough equity in your business. This is what a simple balance sheet looks like. This is the same demo company as the profit and loss that we showed you before. So in this made up land, you can actually, if you cast your mind back a few slides, there are some things here that might arouse your interest, I guess, because it relates directly to that profit and loss. We talked about the idea that 48,000 dollars of income of sales, potentially it hasn't been collected. Yeah, we can see from this balance sheet, which again is this snapshot. Great, we made 48,000 dollars of income. Hold on, 25,000 dollars of that hasn't hit the bank account yet. So that's a bit of a concern, isn't it? Because we know from this business that most of our expenses are salary and wages, which we know that we have to pay pretty much straight away to our employees. Not all of your salary and wages goes to your employees. Everyone's out there screaming, what about the PAYG withholding? What about the tax on your salary and wages? You can see it sitting straight here. You can see that line about 2/3 of the way down the page, PAYG withholdings payable, $9,000. What this is telling you is that, well, yes, we've had $40,000 of wages expenses, but not all of that's gone to our employees. We actually owe $9,000 of that to the ATO, which we have to pay at least once a quarter. It would be once a quarter for a business of this size. So what are you getting concerned about here? I tell you what, if this was my business and I had a bit under $7,000 of cash in the bank, which is that first line, 6878, but $7,000 of cash. I owe the ATO $9,000. I'm a bit concerned. I've got in there a line that's called business bank account $18,000 as a liability. What that suggests is that's an overdraft, business overdraft, or potentially a business loan. I can see that things are starting to add up. I owe $9,000 in accounts payable. So maybe I can put some of them back, but some of those liabilities are going to be due for payment really soon. And that accounts receivable balance is really starting to freak me out. If I'm a small business owner and I'm thinking I've got these bills to pay, running this report tells me I'm going to have to stop what I'm doing and go and put the hard word out on these people that owe me money for the accounts receivable. So that would be, this report isn't telling you a lot of good news, but it is important bad news because you can fix it. It's basically telling you, well, this is an urgent issue because at the moment our net assets are negative. So we've got minus 16, almost $17,000 in net assets. So this is kind of a wake-up call. It's also a wake-up call if anyone's looking at that line. I know we've got a couple of accountants on the line today. Anyone seeing that historical adjustment line? that $19,000 historical adjustment line, that would set the alarm bells ringing because that is obviously some form of mistake. That there is an issue with this company's books, which is hilarious that Xero uses it as as an example. There is a problem here. That is a red flag to your accountant. It should be a red flag to you to say, I don't have the full picture of my business. If my business is telling me I've got a $19,000 historical adjustment that I can't understand in that current liabilities section just below GST, it's telling me we need to do the work so that we can tell this story. Trying to tell the story of a business when you've got a big chunk, two chapters in the middle of it cut out is going to be impossible. And I can tell you what, if you went to a bank to get a loan, potentially you need to extend your overdraft, potentially you need to borrow money to inject some working capital. And they see in this line a historical adjustment amount of that size, that story is going to have a bad ending. So these are just some things to look out for from that balance sheet. Potentially haven't covered them already. The cash position is so important. Everyone running a small business knows cash is king. It's annoying to listen to because everyone says it, but it's true. So you know that the cash is the most important asset that you have because it is there and it's available. All of your other assets, you need to go through steps to monetize it. Cash is cash, so you can pay your debts with it. Um, the number that we were alluding to there, your current position, which is your current asset versus your current liabilities. If your current liabilities are more than your current assets, it means that in the next 12 months, you are going to struggle to pay your bills. There's no two ways about it because you've got bills due in the next 12 months without the assets to cover it. Very, very important thing to do. I can see a few questions coming through. We'll just queue that up with the Q&A at the end, but thank you for sending them through. Couple of scenarios that we might have here. We've touched on this so many times, but it's true. Even if your income is low and your bank balance sorry, if your income is high, your bank balance might still be low. It's that accounts receivable issue. So cash flow management, by looking at these two reports in conjunction, you get a really good sense of where you need to do that. Yeah, and again, likewise, probably the key takeaway from these two reports is the power of timing and that not all assets are treated the same because assets where you've got the cash now versus assets where you've got invoices to collect, you can tell which of those is more important to you right now. When we're talking about ratios, now I would actually give you a word of caution on ratios. Don't get too hung up on them. All that the ratios are doing is describing, I guess, at a glance, some of the conversations I've been having today about what to look out for on your P&L on your balance sheet. You don't need to remember them off the top of your head. They're the sort of things that creep in. So extending that language metaphor to death, they're not the key phrases that you're going to be using on your holiday. They're things that you just pop up as you go. So profitability ratios are pretty important. It gives you a sense of is your pricing right? Are you managing your costs? That profitability ratio, you often hear it said that when you're selling a thing, an object, or even a service, having a gross profit margin of 50% is a rule of thumb that people try and look for. That if you're buying something for $50, you should be ideally selling it for $100 and relying on your cost management for those other expenses, those operating expenses, that you're still left with a profit at the end. So profitability ratios are really important. Liquidity ratios, for anyone that is already in a hire purchase agreement or that has banking covenants. So it's a big scary word, that the covenants. But sorry to drop that C bomb if anyone's worried about that one. It's what that says is that often a bank will only give you a loan if you're sticking within these covenants, and that one of those will be a liquidity ratio. So they'll want to see that, they might ask for annual or half yearly financial reports, and they might want to see that your business is still liquid, because otherwise, how are you going to pay back this loan? So that's why those ratios get really important. So be careful for the contracts that you're signing up to. Solvency ratios is another way of looking at that. As you will all know, if you are directors of a company, in small business or not, you have a lot of duties on you. And I think one of our lawyers, it was Molly in the end, wasn't it, ran a wonderful webinar recently about your director's duties. Well, a very important duty that she spoke about is the duty to remain solvent. So solvency means basically being able to pay your debts as and when they fall due. How do you work out if you're solvent or not? Your balance sheet is a very, very important determinant of that. So being across your solvency ratio by looking at your balance sheet is going to help you really discharge those duties as a director. And efficiency ratios really look at that. We talk about debtor days, how long it takes to collect your average debt. And here's just a quick scenario. There are hundreds of financial ratios out there. I will say that Xero, I think, is launched in beta. It's more detailed financial reporting packs that actually contain a lot of these ratios. I'd experiment, look around, see the ones that suit you, suit your business. It's not for everyone. And if you're very good at intuitively reading a balance sheet, you actually don't need to know how to do these, but it's a good shorthand. So rather than read them out, you can have a look there and have a look at the slides when we send them through later. All right, we've got these reports. We've learned a bit of the lingo. We're starting to understand it. We've picked out the errors. We've got our accountant onto that. Beyond that, now that we've got our nice financial reports, how can we use them when we're planning our business? Well, budgeting. Budgeting is chronically underdone by small businesses, and I get why. It's because you're focused on the now. You're often putting out fires. If you can take the minute to pause, probably around the time when you do your last year end's financial reports, use that data. Don't let it sit in a drawer. Don't let it fester. Learn from it. Learn from it to build your budgets. You can't build realistic budgets unless you know how things have gone in the past. Those P&Ls, particularly if you're in a reasonably stable business, they've got to be building. They've got to be the bedrock of next year's budget. Doesn't mean that things are going to be the same. It doesn't mean because you lost $10,000 last year that you'll lose it again. But it means you should take that as a baseline for next year's budget. And you should tweak things where you think you can make a change. If you know that you can cut your supplier costs, well, okay, let's take last year's cost of goods sold and let's reduce it if we think that we can get a 5% discount. Fantastic. We're just not plucking numbers out of the air. We're not starting from scratch. If you are time poor, and all small businesses are, use last year's P&L to build next year's budget and tweak. Don't just start from scratch. If you're running these reports, if you're in agriculture or anywhere, any business that's affected by weather or by timing trends on holidays, things like that, know your seasonal trends. You can run a P&L in Xero very, very simply on a month-by-month basis. And so you can see the ups and the downs, and you'll know when to plan for them. You'll know when you need that cash buffer because I mean, in my business, as an accountant in old traditional accounting firms, no one wanted to do any work in January. No clients were interested. No one was available. So we would always have to make sure that we buffered because we knew that we wouldn't get much client work in January. It was a bit quiet. So of course, that's when you force your staff to take leave because we don't need them. But that sort of knowledge about the seasonality of your business is really, really important. And look, you can do those forecasts and those budgets, not just yearly. You can do them monthly, you can do them quarterly. Preparing for loans and investments, I've alluded to this quite a bit, but the idea is anytime you're looking to get investors or get loans, it is incredibly important to, first of all, know your profit and loss and balance sheet because these investors will ask you, or these lenders will ask you, but also know what they're looking out for. They want to see, are you profitable? What's your cash flow like? What's the history? What are the growth prospects? Even if it was not profitable last year, can they see a path to profitability? Can they see that you've got, if they're making the decision, well, should I lend this person $100,000? Well, I can see that the business is improving. I can see year on year, if this tracks, that this business is going to be profitable very soon, that it's going to have the money to make it. So having these really clean, professional looking financial statements, it signals a few things. It signals, first of all, hopefully the numbers are good. Hopefully you're telling the story, but it shows that you're serious about your business. It shows that you're someone that's worth investing in if your reports are clean, don't have those historical adjustment errors down the bottom, um, and that basically it shows intent. Gets you ready for tax time as well. You've got to do it. Um, if you keep these things up to date as you go, and if you're running your reports and checking them and seeing that where there are issues, your financials should be ready to go. There's no reason you can't get your tax done early. Now, why would you want to? Well, if you're a business that's been paying tax installments throughout the last year, basically you've been prepaying your tax, which is a bit rude. You might be in a refund position. Always nice to get a tax refund. If your books are clear, if your balance sheet and your P&L are completely, they're correct, they make sense, we can do your tax really, really quickly, get you out the door, get that money in your account. So some red flags, we've already mentioned all of these, but these are all things that you can see from your profit and loss and balance sheet. You don't need to do a deep dive. If you've got up-to-date records in Xero or your accounting software, we can run these reports and see these red flags straight away. Once you're an accountant that's got a few years of experience, and everyone in my team has at least 5 years of experience, plenty of them are over 10 years, they can spot these flags at 100 paces. You can run these two reports and instantly see where your business is at risk. So really, really important in terms of picking up problems while you've still got time to deal with them. Before the receivers come in, before the ATO comes knocking, we can help you by identifying these red flags. So those final takeaways, if you can't remember it all now, don't worry too much. I would just say get stuck in. If you're a small business that runs on cloud-based accounting software, you're not going to break anything by running a report. Don't think, oh, my accountant's got it covered. Oh, it's all boring. Let them worry about it. Have that little bit of literacy. Ask the hard question. Talk to your accountant. Go, hold on, this is on my balance sheet. What is that? If they don't know, probably time to change accountants. But if you don't know as well, and if you're trusting them, maybe that trust is misplaced. We speak a lot in our profession about the idea of a trusted advisor. The reality is, not all accountants are cut from the same cloth. You shouldn't trust any accountant until they've been able to demonstrate that trust is earned. And that should be over time as well. So run your own reports, try and get dirty, get your hands dirty. I would say that a subscription model like Lawpath is really good for that because I know that small businesses don't like calling their accountants because they're going to get a bill. It's a fact of business in our way of working that we've got to get paid for our time. Subscription model takes the pressure off. You've paid for access to your accountant. It's on our job to perform for you. You can call up, you can book in on our accounting advice platform and say, I've just run my balance sheet. What is this? I don't have no idea what this is. And that's what we're there for. We can answer you nice and quickly. No stupid questions. We know that we run an area that is a bit niche and that isn't for everyone. We're happy to help you run your business. So just as a quick reference, just a reminder of the difference between the P&L and balance sheet. The P&L is a story over a period of time. You define the time period. You pick the start point and the end point. What were the last 6 months like? How's our business been going since we launched this new product? That's what your P&L tells you. All the good, the bad, and the ugly. The balance sheet is a snapshot. The balance sheet tells you this is what you've got, this is what you owe. This leftover is basically your profit that you've generated since the beginning of time. Those mistakes aren't really balance sheet and P&L mistakes. All I would say is keep consistency is probably the biggest common mistake. If you're not consistent in updating your records, it's the old garbage in, garbage out principle. Your P&L, your balance sheet isn't going to teach you anything if the numbers underlying it aren't correct. Another good reason to have a subscription-based accounting plan because then we can keep you up to date as we go. We've told you those takeaways as well. Ask an expert. That's what I like. I think I like to teach someone how to fish as an accountant. That's what I really like about Lawpath customers is that they they come on a model that's often self-service. You know, they want access to legal documents, they want access to tax things, but they don't want to do it all. They don't want to pay someone necessarily for rubbish. That's why it really works for us because you can basically teach yourself the nitty gritty while we do the value add. We do the bits that are actually going to make you money and save you tax. And we'll teach you to understand your finances. We won't just say, just trust me, it's fine. It's all correct. It's all correct. We'll teach you to have a deeper understanding of your finances while we take care of your compliance. Might just pass back to Joel just to talk about a little bit more about Lawpath. Now we can help.
Timothy, Quinn, everyone. Thank you so much, Tim. So, thank you everyone for staying with us through today's session. I hope you've got lots of insight into your profit and loss statement, balance sheet, financial ratios, red flags, and how to use them to steer your business in the right direction. Before we head over to the Q&A, I wanted to share something important. When you are in those early years of business, having a professional accountant and tax agent by your side isn't a bonus, it's essential. In Australia, nearly 20% of new businesses fail within their first year, and around 48% will have exited, closed by the end of 4 years. Now, this isn't me just reading a random report. I'm one of the consultants over here at Lawpath. My job is to speak to people inbound and outbound, at least 80 or 90 people per day. Now, if you see in the movies or in real life, you've got the people on death row in the American films, and the priest is usually taking their last confession. That is literally what I do every day. I've almost been traumatized out of ever wanting to run my own business because it can be absolutely and utterly devastating to hear some of these cases. People with amazing ideas, apps being developed, or someone will tell me something, and while I'm on the phone, I'm like, "Hang on, this sounds surely someone's made this before," and I look it up and it's never been done, but it's going out of fashion, or someone has gone and stole their idea, trademark, patent, whatever. So I'm very, very much enthusiastic about working here at Lawpath and providing as much guidance as I can, me not being a lawyer and accountant, but having enough knowledge to know when I can interject. So when we convey this free information to you guys, it's obviously helpful to you and we want to help. That's all we care about as Australian businesses. Our prices should be indicative of how we're not greedy. However, we do obviously need to um, push a bit of our product as well. And again, it also falls back on giving you a cheaper and more cost-effective option that's more accessible as well. So one of the top reasons cited is financial management. Things like poor cash flow, for example, is what we see all the time. Inadequate or wrong record keeping, failing to understand tax obligations, and not having reliable financial reporting is usually what we're seeing with businesses going under within 1 to 4 years. The balance sheet and P&L are often the two most powerful reports you'll have, as Tim conveyed. They are the shortcut to accounting. They give you a snapshot of financial health, profitability, debt, assets, so you can make quicker, better decisions. That's why new businesses are always recommended to get the right education on how to read and use them properly. So having someone experienced to help you interpret those records and reports, avoid costly mistakes, comply with tax laws, make structuring decisions, and spot risks early make a huge difference in the survival and growth of your business. And this is what our plans were designed for. We didn't build a model and push it elsewhere. We designed our model around the statistics of what people are dealing with day in and day out. We began as a law firm, and then we built an accounting and tax section as well. Now, because we are very much an AI-based platform, online AI and subscription driven, we just have a very large team downstairs who are constantly running reports and statistics. It's all they do. They don't leave their desks. As far as I'm concerned, they're like the guys from the Matrix with the things plugged into the back of their head. That's all they do. It's data, data, data. So we've built out our models and our services around that, and especially our prices for small to medium businesses. As Tim mentioned, in regards to an accountant, if you have a question that needs to be answered and it can be answered within 2 minutes, do you want to go and speak to your accountant? Regardless of whether or not you have a lovely relationship with them, it's still going to cost you money, probably more than you'd like to pay for a 2 minute response. Wherein with us, subscription model, for example, you pay once for in this circumstance $1,668 for the accounting advice plan. You have 12 months access to a senior chartered accountant. That accountant can answer questions whenever you want. Click of a button. You don't have to leave your office. I've looked at the poll as well. A lot of you guys are working from home. It's a bit of a 50-50 mix. Even if you are working within a facility or an office, whatever, you may not always have an opportunity to leave if it's a new business and you need to look after younger people around you who might be your first employees. So the beautiful thing is you can sit on a computer, book a next day or same day consultation with a senior lawyer and accountant, ask them those questions, share your screen with them, get your Zero up, get your MyOb up, get whatever program you're using, and we can physically see what you're seeing and teach you and educate you as well. Small price to pay. Um, what you pay for is what you get with us at Lawpath. With the tax plan, it's not as DIY as the legal and accounting. We would just straight up do all your best tax financial reports. We can go through the P&L with you, all that jazz. We also offer a lot of information in relation to tax strategies, which can be used on either platform. And if you have someone like Tim or one of his staff assisting you, then I can't imagine you'd ever really fail. We can't make you millionaires. Obviously, that's your side. But on the compliance side, we are going to protect you and set you on the right track. Now, a lot of people are also saying in the polls here that you guys have put that you also already have accountants. That's great. If you have a long-standing relationship with your accountant, we're not going to sit here and try to convince you to jump ship. However, if you're having to come to these webinars to get extra information, whether it be free or not, you could be killing two birds with one stone by having us as your accountant and getting that information whenever you want as well. Not having to RSVP, not having to watch a YouTube a recap of this today's Lawpath episode later on. We are consistently and constantly available for you guys whenever for 30 minutes a day at a small fee. So if anyone is interested in moving forward with any of our assistance or plans, I will contact people afterwards. Unfortunately, a lot of you guys have had to receive calls from me from last week as well, and everyone's saying I'm a lawyer or I'm an accountant or it's just a refresher. So, yeah, but there is those of you out there who need assistance. So if you are interested for me to call you sooner rather than later, you can put yes in the chat, and we can reach out and offer you some of our pricing and some more service. Otherwise, I'll likely get around to you guys later on. Tim, I dare say it's Q&A time. I believe the first question came through in Q&A was from Felipe. Why is marketing included in SOGS in my P&L, but advertising is included in the OPEX?
COGS. I won't hold it against you though. Why is marketing in your COGS? I don't know. It's unusual. Philippe, I'd say that normally marketing and advertising are both considered OPEX, which is operating expenses. It's unusual to see marketing in your cost of goods sold. But again, it's really up to you. That's the best thing about having a zero file or something like that is that you set your chart of accounts. So I would say it's probably an error. You can probably move it. If marketing is considered so vital to the delivery of your product, then potentially that's why it's in COGS. But you could easily reallocate that. I'd probably recommend it. Nice, easy one. I will go through the chat now as well. I can see there's some questions going back a little bit earlier as well. Philip has asked, what's the best and easiest method to calculate cost to open doors every day? Yeah, cost to open doors. That's I haven't heard that phrase for a little while, but that's basically your core profit, your core business is it's almost your revenue divided by your cost of goods sold. It's with probably your wages then taken out. I guess if you're in the sort of business where you have that decision on whether to open doors on a particular day, and you'd assume that your operating expenses are what they are, but whether you open doors or not. So potentially, if you're like in a cafe and thinking, well, should I open on a Sunday? You would look at your expected revenue for that day, and or if you've already been doing it on a trial basis, you look at your actual revenue for that Sunday, and then you would subtract, well, what was the cost of goods sold for that day? Potentially you had more spoilage or more wastage, so potentially the cost of goods sold for that day would be higher. And then you'd subtract your wages, which, as we know, on Sundays are much higher if you pay the right reward rates. That would be how I would, in that sort of sector, without knowing your business, Philippa. That's how I would calculate cost to open doors. What came in that day versus what went out on that day. And you can run it at that level of detail, particularly if you're selling products and you have a point of sale system, you'll be able to break that down pretty simply like that. So I'll just keep going through them. Fiona's asked if an intangible asset is less than 12 months, is it categorized as a non-current asset? No, if you had an intangible asset that you'd expect to, I guess, expire or be monetized fully within 12 months, it would be a current asset. I'd say that's unusual, and I'd love to know more about what that intangible asset is. Most intangible assets, I think they have a longer, perhaps an unascertainable useful life, and certainly more than 12 months. If you think about a client list or something like that, which is a common intangible in small businesses, they're typically expected to give revenue over more than 12 months, but possible. Joel's asked, wouldn't when you lodge the BAS, it would all be accountable for and potentially don't have to pay this amount? Very good question. So what that would happen when you're paying salaries, every time you do a pay run, that PAYG or that tax on salaries balance will increase. When you lodge your quarterly BAS and pay that amount, the liability decreases. So that's absolutely how that liability would decrease because you've paid it. So a liability is what you owe. When you pay what you owe, that balance comes straight down. Keep on going here. Fiona's asked a very good question. What's an example of a historical adjustment? I don't think I've ever seen one that's been correct. I think it's typically an error. I think you often see them when someone converts between accounting packages. They'll go from MYOB to zero, say, and there just hasn't been enough information there. And so you typically see those balances sitting on balance sheets for forever. Now, is it a real liability, a historical adjustment, or is it a real asset? Because it can go either way. Not really. So typically what I'll do with a client that comes on board with that balance, if we can't justify it, if we can't reconcile it and say, well, this is what this asset or liability represents, I'll get rid of it. I'll clear it to the profit and loss because I just don't think there is a justifiable reason for a historical adjustment. I think it's just an error. Oh, very good question here. What's the difference between a balance sheet report and a trial balance? A trial balance is it's your balance sheet and your profit and loss combined onto one report, which is why for most people it is completely pointless to look at it. It is something that is useful for accountants to look at. And beyond that, I would say don't worry about it. Yeah, it's the combination of those two reports on one. But if you don't know what you're looking at, it can be hard to tell which part's balance sheet and which part is profit and loss. So I'd stick with your balance sheet. And then Diane has asked, typically, what percentage should you put on a subcontractor's invoice? I assume what you're saying is what's I guess a margin to be charging. So if you've got subcontractors that you're paying, how much extra on top of their charge should be charging to your customers? That really depends on your business. I would hate to give you a number that was wrong for you, but the best thing is when you have a profit and loss is that you can play around with those numbers. Have a look at what if you were to charge 20% or 30%, what would your business look like? Would it still be profitable? Do you need to charge more? If you need to charge more, then you need to charge more. So when we talked about that sort of rule of thumb of 50%, if your business was purely hiring out contractors and selling their services out, I'd say your charge out, your markup should be a lot higher, should be probably 100%. If you imagine in that scenario that you paid a subcontractor $50,000, I'd be wanting to make sure they could pull in $100,000 of income because you still have other expenses and you still want to make a profit as well left over. So I'd say typically, depending on your business, Diane, you might be looking at a much higher markup rate than that. I'd say in traditional accounting firms, not Lawpath, thank goodness, because we couldn't, our fees would have to double. In a traditional accounting firm, there used to be a thought that you, as an accountant, you should be generating revenue of 3 times what you're paid. So if you're paid $100,000 a year, you should be generating $300,000 of revenue. So you can see how different businesses have different ratios and different rates. Um, I think that might have come to the end of the questions. Guys, we always do have a few more minutes if anyone would like to jump in with it with a few more questions. They've been really good questions, guys. I really appreciate everyone who engages on these things. It's always exciting to get to meet new people and get to share my love of accounting, my unyielding love for accounting with the rest of the world. Please do jump in with any other questions. Otherwise, I'll leave with Joel to close us out.
Thank you, everyone. If there's no other last minute questions, we'll go ahead and finish there. What is the ratio for selling an IT company?
Again, there's no one-off ratio that'll work you there. If you're talking about for selling a company or a business, that's a different question entirely. If you think rather than just selling a product, selling a business, you often see 3 to 4 times your annual profit is a pretty similar, pretty common ratio for a small business. Some businesses that are consulting businesses, 1 times your annual revenue is often quite similar. But yeah, and speak to your accountant there because it depends a lot on your business.
And Julie asks, is there a maximum corporate that Lawpath can advise in?
Not quite sure what we're a maximum corporate that we can advise in. I would say that we have, in terms of the sort of businesses that we can service, we can go anywhere from complete startup with no revenue at all the way up into multi-million-dollar businesses. We've got support for everyone out there.
Thank you guys for the wonderful questions. If anyone, thank you, Mark. If anyone did miss it, we will be sending an email out with essentially the webinar itself, as well as the slides and all the other information as well. So I do believe we have one last question from Richard too.
Yeah, one last question. You got in there, Richard, just at the end. Retained earnings are that section just in that last little bit on the balance sheet, which is in equity, in owner's interest. We think of it as a residual. So what's left over? Your assets are what you got, liabilities are what you owe, your equity, of which is where retained earnings sits, is what's been left over. So what is the profit that you've generated over the years is your retained earnings. So that's why they appear in your balance sheet. And when you declare a dividend, that balance shrinks. It's basically the retained profits that you've built up over the period.
Perfect. Thank you, everyone, so much for attending. Tim, always a pleasure as always. Thank you so much for your time. Anyone who has any follow-up questions or is interested in having a chat, when I do send the email out this evening, feel free to respond there. That is my contact information. More than happy to offer you guys any further details to Lawpath and how we can assist you. But for now, thank you so much for your time, and we will see you next time. Thank you so much.